Hello and welcome back to Crypto Clarified. My name is Vinh, Tran, Associate Director of Business Development at WisdomTree Digital Assets.
And I'm Dovile, responsible for digital asset research here at WisdomTree Europe.
And today we're joined by Ilan, Senior Global Markets Strategist at Marex. He will share his 2026 outlook for crypto, how to think about allocations and valuations, and where the next wave of investments will come from.
Hi, Ilan. Great to see you here. I've been reading your emails as frequently as you send them to us, and I absolutely love your perspectives on what's happening in crypto market. So now it's very great to kick off our recording in the new year. And it feels like crypto mood is much brighter, much happier at the start of 2026. How do you view this?
Yeah, so I think this is the outcome of a pretty positive year that we had from a fundamental point of view, even though the price action obviously has been a little bit less exciting. But I think that the way I would characterize it, if you allow me a bit more of a philosophical take here, is that I think 2020 and 25 really changed the perspective from an existential risk for crypto to let's say a relevance risk. So all of us have been in crypto for a long time, have always went to bed at night wondering if we'll wake up and it'll be over. Like Tether would blow up, would be regulatory would ban crypto, or if the bridges wouldn't work anymore for fiat. So we lived with that fear. And I think last year really consolidated the view that crypto is not really going anywhere. That we are integrating for the financial markets, for example, Marex, where I work, and to all major financial institutions. And really what can hold us back is performance, can we deliver anything interesting or not? So that shift from existential to relevance risk, I think, sets the background. So even though we started the year we came from a relatively bad year, I think there's enough fundamental positive news here that can take us to a better place this year.
And when you talk about fundamental positive news, I know that there are regulatory developments such as Clarity Act in the US. I know that now yield is becoming more of a focus for institutional investors, such as staking yield that you get for Ethereum or Solana blockchains. What other fundamentals or key development factors do you see this year?
So this may sound a little bit counterintuitive, but at least from where I sit, I think a lot of what happens from the point of view of external investors, now we can talk about crypto investors separately, but macro funds, for example, that are multi-asset, I think what really helps crypto is the leadership of the equity markets, the Mag 7, for example, being diluted. So I think the lack of trend elsewhere that really changed the risk reward of investment. So for most of last year, or even for the last 3 years, there was nothing that beat from a Sharpe ratio just investing in Mag 7. And it was just like, why would I mess around with other assets? And now I think that there's a lot more distribution of gains, and there's less things are less obvious in terms of what's happening. So that creates a lot more money flowing into other assets. We see now, for example, the equally weighted S&P performing very well, suggesting that money is flowing more, like capillarizing through the system. And a lot of this is finding its home in crypto. So I think that helps a lot. Another thing that I think helps is gold and silver having moved so dramatically, and so many investors having missed it. I think there is this sense that you're rolling down the curve of assets that in some way are related. And I think, Bitcoin and crypto are somewhere in that space. And it's speculative, but there's some elements of store value. The narrative of debasement of the currency resonates to some degree of the population that invests. So I think a lot of it comes down to the competition for attention and flows. I think is less severe now, 2026, than it was when NASDAQ was trending basically like a diagonal line. From your point of view.
And when I talk to institutional investors all across Europe, LATAM, in all the regions that I dial into, I tend to tell them that if you want to be market cap neutral investor, you should have market cap neutral allocation to crypto, which at the end of 2025 was 1.2% of the total portfolio. If you take a look at all listed tradable instruments, equities, fixed income, alternatives, commodities, gold, digital assets. Digital assets were 1.2% at the end of
Interesting.
last year. And of course, this 1.2 figure changes. It moves up to 1.7 if you look at the end of other month. It moves down to 1% if you look at the end of the other month. But allocation somewhere between 1 to 2% is the market cap neutral allocation. So if you want to make no active decision, you should have approximately 1 to 2% invested into crypto. This is what I say. And most investors, when they hear this, they start looking at Bitcoin and they say, okay, Bitcoin is volatile. It does not really suit my portfolios. And I say, yes, it's volatile, but it's not correlated to traditional assets. So adding it still improves your risk-return metrics. So this is the standard discussion that most people now understand, follow, and trust. But how do you go from Bitcoin to other digital assets in the space? Like, how do you think about it?
Yeah, so this is so much to say. I mean, it's very interesting what you just said. I have like, so many comments about it. I mean, before I get into that part of it, let me just make a little comment that I find it very interesting the conversations you're having. In our side, the type of conversations we're having are, I want to allocate to crypto, and the reply you get is, oh, it's very volatile. The answer that we often get is, how do I invest with some degree of capital protection, for example, or how do I get exposure to it while limiting my downside? So the conversation never is, oh, like how much do I allocate? It really is about how do I allocate. So like structured products for us have become extremely popular because an investor can, as you say, express that view you mentioned and say, well, I want some allocation to crypto so I can buy some like Ethereum and Bitcoin together and get, I don't know, 25% capital protection or something like that, or do a yield type product. So for us, our version of the conversation really has been of how to get exposure, and using derivatives seems to be like an easier path in for many of the investors. So I just want to kind of put that there because I think it's very interesting from your point of view. So in terms of the valuation model and like how to get investors interested in other assets, I think it really depends on if you're talking about crypto natives, or if you're talking about or crypto savvy, or if you're talking about crypto or traditional finance. I think for traditional investors, it really is, if they're not really close to the system, it really is a question of how they hear the narrative. So for some of them, it really appeals the Bitcoin story of supply and the digital gold side and the kind of a dollar hedge. So that really appeals to many of them. I think for many others, they really are looking for more of a beta type of behavior. So they look at Bitcoin close to 100 and think, how much upside do I really have on Bitcoin? And they will think, well, if I'm going to invest in Bitcoin or in crypto, I mean, I'm here to make like a very large return, so they will look for the beta side of it. So that's one other point of view. The other one is of those who are a little bit more plugged in, I think is of owning a part of the infrastructure that is being built. So they see the headlines of JP Morgan, of BlackRock, of all that, and they see protocols like Ethereum or blockchains like Ethereum and say, I don't fully get like the valuation and the pass through and the burn mechanism and all that, but I want to own some of this because I can see clearly that this is important. And so I think there's that level. So that I think that's a traditional investor side. The crypto side, I think is a different world because I really feel like we are right now an asset class really in search of a valuation model. And we cycled through so many models, like, all the way from like the Murat meme coin all model to, earnings, to like some kind of moats, to like a type of from an equity point of view, like a growth type stocks. I have no revenue, but like I'm going to be gigantic in the future type of model. So we've been cycling through these models forever, and it just feels still unresolved, like at this stage in the game, which is kind of embarrassing, to be honest. I remember the last one that I had some confidence is we look at things like Hyperliquid or back then Pump Up Fund or the protocols that generate yield. I think, okay, well, surely if you generate revenue, and surely that is like the one, right? I mean, but but not really, because the madness around like search for value and beta and allocation is so much that it drowns that kind of perspective. And even Bitcoin, to be honest, is still in search for a valuation model, in my opinion. And this goes to both sides, crypto and non-crypto investors, natives and non-natives, because this really was a year in which would be super helpful if Bitcoin had, outperformed gold, or at least, kept up, but it didn't. So like, however much I would love if it did, the truth is that it didn't really serve as well of a hedge as many would have liked to. Now we can create hundreds of caveats and explanations, but when I sit with an investor and he looks at it, it says, I don't get it, So that's the crisis, existential crisis we feel, like emotional crisis we're in.
At least I can see that I'm glad that Bitcoin broke its 4-year cycle.
There you
So
go.
that's at least that story is
I don't know
over.
if that's more confusion or less, but whatever it is that happened.
At least it's over. But you mentioned interesting thing about stuff being built on, for example, Ethereum blockchain. And now Vinh, he's my colleague in the US, very much focused on tokenization that's happening in the space. I'm sure he has many, many strong views about this. So
No, exactly. And I think that's a good segue, Dovile. So thank you. And you mentioned a very interesting part, and I love how you kind of split the two lanes between the traditional investors and the more crypto native investors. A lot of what we focus on within the US on the tokenization front is how do we bridge that gap? So I think to your point earlier, you could talk about price action, you could talk about cryptocurrency assets. I think you were alluding to it, but what within the crypto world are we really building? What are the actual use cases that can then transcend both markets, right? That valuation model that you mentioned. Where do you see that trend going from a use case perspective? Because you mentioned a couple players. You mentioned Pup.fun. You mentioned Polymarket. These are apps that have been built on crypto rails that have shown some sort of success in the past year. Do you think those trends continue? Do you think other sub-industries emerge? What's your view on that?
Yeah, so there is what I would like to happen and what I think will happen, and they're two unfortunately different things. So what I would love to happen is if crypto had really a reach outside the speculative financial sphere, but I don't really see any tangible signs of that happening, really. So and not to say that it resolving in finance is necessarily like a bad thing, but it would be nice if it was wider. But right now, I do think that most of the use cases really are of financial nature, and I think it will continue. So undisputably, the easy one, to be kind of redundant, but stable coins as an infrastructure payment, really like financial infrastructure, especially for regions with capital controls and high inflation, so forth. I think that's like, I don't think I need to expand on that. I think everybody's pretty understands that. In terms of DeFi, I think is where I expect the real growth to happen. I'm very kind of bullish on DeFi as a concept, and I think it brings something unique to the table. Well, not unique, but very unusual to the table in terms of finance. And the way I usually frame this conversation is the difference between credit risk and smart contract risk. So in traditional finance, as you know very well, everything runs on credit risk, right? So you take a mortgage, a swap that we do in FX or grains, everything 10-year treasury is the U.S. government's credit risk. Everything is credit risk. DeFi is the credit risk, at least at the first level, does not exist. Really what exists is smart contract risk. So if you're in Hyperliquid or an Aave, you can't like pick up the phone and say, oh, no, actually, hold on. I got an inheritance from my grandmother. Like, don't liquidate me. Like, I can send you the comfort. Like, you can't talk to the smart contract and tell Aave like not to liquidate. Oracle says, you're done. And so there is no credit risk. I cannot not pay. Right. So that is something very special, I think. And I can even tell you a use case that we've been playing around with and looking how to structure it is putting the full payoff of an option on chain, for example. So, we are an investment grade company, NASDAQ listed, but we're not AAA, right? There are some companies counterparties that will only deal with AAA companies or not almost AAA companies, right? And one solution and they would love to transact with us, but they have some kind of mandate restriction. But for example, we could create a vault in which we deposit, so let's say simplest example, there's like a call option or something, we can deposit a huge amount of, or the entire payoff of the option on chain in an escrow, or in a smart contract that distributes it to their wallet according to the settlement price. So they substitute our credit risk for the smart contract risk. Assuming there's no bug in a smart contract, there's no hack, it's done. Like there's no credit. So I think that use case will gradually, I think, investors will gradually come to that light bulb moment of we can eliminate a lot of credit risk from the system by using smart contracts in DeFi. And I know it's there in the back of people's minds, but I think until someone really operationalizes this into a real use case, it won't become as clear. So I think DeFi for me is very interesting. The composability I think is very interesting, and I think BUIDL, BlackRock's money market fund on chain, gradually will become more composable, and people see how collateral can be used and different things. So I think those building blocks are very attractive, and I really think that's going to be kind of one of the key elements. Last one, I think I would say, well, a couple more perps. I think we're going that direction, and I think that's going to continue to be like a new game mode, that not new, but a growing game mode for investors. And AI, I don't know if you guys want to discuss a little bit about this AI crypto intersection. Is that, yeah? So I'll give you a very, very kind of simple view. So I'm very skeptic about the bigger claims of AI and crypto, but I think there's one area that it will be like really a killer product, and that is delta neutral. And we already see many delta neutral AI protocols out there that will, for example, get a pool of money and move them around between Aave and Morpho. They just simple, like where's the highest deposit rate? And it will be moving the money around and to always get, at blockchain speed, the highest rate between, MakerDAO or Aave, blah, blah. And I think applications like that will develop, and soon we'll have cash and carry type, of vaults. So it's like the old robo advisors, mutual funds that exist. And, for me, the delta neutral type trades, or those kind of, like market neutral trades, I think that's kind of like the white collar worker in the AI revolution, the first to get hit, right? I think in discretionary investors will take much longer, but it's going to be very hard to justify me physically going around looking at like where's the higher rate from Aave or Morpho. Like I could just put in a vault and AI will just like instantly move it around. So I think that's where it's going to be really interesting.
I agree. It's very, very interesting. But as I'm listening to you, I think, is the AI really necessary for this? You can automate it with less technology, just having proper data feeds and, some decision-making rules within the computer. So AI, I think, is a step beyond. And my personal view is the blockchains I talk to that try to market themselves as AI blockchains, most of them are using AI just for marketing purposes. As soon as I start digging, what does AI mean for you? There's nothing. Or at least I haven't come across anything that I would say like, wow, this is the real use case of AI within a blockchain. But please let me know if you disagree.
No, I agree in completely what you say. I think the marketing side is very important. In the case of these protocols, I think you're right. At the simplest level, you can just write a code that says, oh, which one of these three is higher, and put the money there. But I think the AI level, my suspicion comes more in like the risk management part of it, the communication part of it, and the understanding of the like changes in protocols, and be able to read, for example, oh, is there a signal for like a hack in something, and be able to react to that. So I think that's the layer of risk management where it starts becoming a bit more interesting, and in multi-layer, try to expand from what is more of like a machine learning type of scenario. But that doesn't take away from what you said. I think generally speaking, just like the same, a lot of people say, do you actually need blockchains for this, solve this problem? I think the same version, your question is 100% correct. Most of the time you ask, do you actually need AI for this? Most of the time you don't. So I think that's spot on. Yeah.
So one,
Thank you.
sorry,
And
go ahead, Dovile.
go ahead. Hello.
I just
go
wanted
ahead.
to add to the point that you said earlier on composability and why blockchain is important to this. And we talk a lot about tokenization within the US and how a lot of institutions are bringing tokens on chain or assets on chain. They call it RWPs, right? So you think funds, you think different asset classes, equities, fixed income on chain. And the reason is not to just bring it on chain for the sake of it, because to your point, why do we need to bring it on the blockchain? The point is composability is to be able to access it and then be able to move it around in a composable way to access different lending markets, different yield sources. So I think that's something that if you can double click on that, it'd be great to simplify that for users, right? Because to one point, I understand, and I'm sure Dovile understands what that means. But for the average retail user or even institutional, what does that really mean from a uh, divestible, type of a asset class?
So for me, the easiest example is gold, right? So for example, Tether has a gold-backed token called XAUT, right? And you can, for example, if you go to the Hyperliquid blockchain, it's growing dramatically the use of XAUT as collateral. So you can get XAUT that tracks gold one by one. Again, you're assuming that Tether is reliable, has that gold, and that aside, which I suspect they do, you can get that token XAUT. So if you buy an ETF of gold, you're basically paying management fee to the ETF holder. If you get that token, you're paying virtually nothing, and you can use it to deposit in the equivalence of Aave in a hyperliquid EVM, and you can borrow from it. So you can do it. You can use it for leverage, or you can use it to do something else. In a limit, if you have a gigantic gold holding, you can take a loan and spend it if you don't want to spend your gold. So I think the easiest way to understand it is that you can suddenly unlock the potential of an asset you own if it's on chain. And the first layer of unlock is being able to borrow against it. So use it as collateral. That's the first layer. There's other things you can do, like you can strip it down, like Pendle, for example. You can strip down parts of it, like you have income and the underlying, and there's all kinds of interesting things you can do. But at the first level, it can be used as collateral.
It's very interesting. You just clicked on my head. Looping products. What do you think about them?
I mean, in many ways, it's like recursive lending, looping. Right? In many ways, it's just
Yeah.
efficiency. Like if the bar, so like using an easy example, right? If wrap staked ETH is yielding, let's say 5%, just for the sake of the argument, and you can borrow, ETH at Aave at 2%, like that's a market inefficiency. So basically, you're saying that the credit risk of wrap stake ETH is 3%. If I mean, dirty math, but this is just the market correcting itself. Like it means that the yield of borrowing ETH should be much closer to the yield that it produces. The same way, like if you look at in FX markets, interest rate parity exists, right? You can't, like, the forward market for not for China, but for most currencies is basically a formula of the relative interest rates. Like you can't have it differently. Otherwise, you can borrow in LIBOR or in the US or Euribor and deposit somewhere else. So they have to hold. So this for me, the looping is it was in the past, I think, a source of some kind of like financial stability risk. But for me, I think it's just normal market efficiency being corrected, to be honest.
I like that you use the word efficiency, because it really is that, right? Is the unlocking of capital. And it reminds me of it's a short anecdote, but I have a friend that invests in art, and he tells me that he wishes he could use that capital that he's put into this art to buy more art or do other things.
Exactly.
And then that's something where I say, that's the blockchain. Like that's something you can do.
Exactly.
And that's like a clear, you could translate that use case to the
Exactly. I mean,
average
back in the
person.
days where NFTs were happening, this is exactly what people did, right? So for me, it's really simple. That I mean, it's just that in every financial system there are interest rates, and they need to kind of equalize across the system in some way. And if looping exists, it means that there's some preferences there that are kind of ineffective. If the deposit rate in Arbitrum is 10% and the borrowing rate is 6% in mainnet, that someone has to close that somehow, right? So that's just a simple version of the looping. But it is a bit scary. I because the size of it is so crazy big, and the pieces get a little bit like are somewhat they look somewhat like fragile. So I think that the case in which it becomes a bit more kind of egregious is when you have, for example, PTs from Pendle being lent with this is like already a very complex instrument being lent as collateral to borrow and create more PTs, and then you go to Athena and you mint in USD, and then you take it to Pendle, and then you loop it back to Aave. So I understand the unease about it, but
Yeah.
ultimately it's
And
efficiency.
and even a lot of what you mentioned now, I'd love to get your thoughts on this, is kind of powered by incentives, right? They're
Yeah.
either protocol incentives or issuer incentives that want to incentivize TVL. That, to me personally, I don't see that as a sustainable route. How do you create both efficiency and then sustainability within these types of markets?
Fantastic question. If you figure out, I'll send you a lot of VC friends to talk to you. But I think that like the real answer to this is that the generous point of view here is that incentives are a customer acquisition strategy, and you pay for it, and then you get the customer. Like Uber, for example, was subsidizing rides effectively for years, right? And they have a business now. So you can imagine that blockchains or protocols are trying to do that. Unfortunately, the barriers of transfer are so small and the capital so mercenary that I think, as you very well pointed, that model is difficult to believe in, like unless you truly have a good product. Like one could argue that Hyperliquid, for example, succeeded in that because it incentivized people with the airdrop. A lot of people went there because they were farming airdrops, and people stayed and they continued to use it, and it's still the dominant purpose protocol. So one can argue that's a generous interpretation, but I think the more realistic for the majority of protocols out there is a less generous one, that there is a very perverse setup between venture capitals and between the protocol founders and users who want to be liquidity and promises of airdrop. There's kind of a very negative incentive structure going on there that the end user will be farmed one way or another eventually. But that's not all of them, of course, but I think that's a big subset. So I think I tend to agree. I think that model is going to gradually kind of go away, but I think that's part of a wider discussion that I think the longer tail of crypto, both protocols and blockchains, is going to fade basically, and that's kind of fade. I think the axis is going to shrink horizontally and expand vertically. So that's kind of how I think about it. And that model you're describing is a very good model for long tail. Like people don't know what's going to happen, what's going to be worth it. Everything could be worth a lot, and like nobody knows. So incentives work there, but as people stop caring, it becomes less important.
But now if we make a step up, let's say, and we look forward to 2026, we see what is happening in the markets. All the investors have expectations for rate cuts. All the investors have expectations for how equities may perform. How should they think about, let's say, top 5 crypto names with respect to how they decide whether to allocate more to Bitcoin, whether to allocate more to ETH, whether to allocate more to Solana? Like, how would you guide professional, traditional, institutional investor through the choices that they have in this
Yeah,
ecosystem?
so I think it really did. I mean, it is a hard question to answer without knowing like what level of if they're on a shallow end or the deep end of the pool, But
Let's say shallow. Yeah.
yeah, so for the
Yeah.
shallow end, I think the goal should be to get broad exposure without being diluted, right? So for example, Solana's inflation rate, that's what like the term I don't think is really exact, but anyway, the inflation rate of Solana is much higher than Ethereum and Bitcoin, especially Bitcoin. So like if you're buying a spot ETF, for example, of Solana, and you're paying a fee on top of it, you're effectively being farmed, right? So because you're getting diluted, everybody else is staking Solana and getting whatever it is now, 6% or something of interest, and you're effectively subsidizing other people's interest. The same thing to a lesser degree happens in Ethereum, but the staking rate is much lower.
So,
Yeah.
so investors need to go into products that do stake. We have those in
Yes,
Europe. I know in the US it's a different story, but in Europe we have products at stake, so it's much better for the
I think
investors
so.
here.
I think so. If you want to invest in something like Solana, I mean, unless you have a very strong conviction, like shallow end investors must understand that they are facing a disadvantage of 6% or whatever it is, the staking rate that someone like me can go on chain and get by doing nothing, by simply staking it or using a liquid staking. So they must understand the disadvantage of that. Now, the Solana inflation rate is declining and it will decline, but currently that's the situation. So, from a basic point of view, I would encourage to look for either, if you're going to have a broad exposure, the variable that I think that people underestimate is, are you being diluted or are you not being diluted, right? So from Bitcoin to Ethereum to Solana and then down further out, the more diluted you're getting. So the more important it is to look for a vehicle that offsets that. As you said, in Europe, we're staking rates, and at some point they'll have them in the US. So I think from the investor point of view, from the shallow end, I think I'd say that try to give it more. I love that kind of perspective you gave. Like 1.2% is more or less, if you're trying to allocate, formulaically. I think that's a great way to think about it. But in terms of what assets within it, I would try to make sure you're not like at a disadvantage compared to the natives, basically.
And also, so I am convinced that every single investor should have at least market cap neutral allocation. I'm also convinced that very few investors have sufficient knowledge to make active decisions to massively overweight crypto. Like small, regular rebalance allocation is what should work best for the majority. But what would need to happen this year from unexpected perspective for investors to want to stay away from crypto? Like, what could happen to have a negative impact on this market?
So I think it depends a little bit on the region, but let's just say, broadly speaking, the risk that I'm like a little bit perhaps more concerned that than most people out there is the reputational risk of crypto. And I think that this may be a bit controversial, but I think Trump was a very mixed bag for the crypto industry. And there's not a political statement. There's nothing to do with what I think about Trump. It just has to do what I think the impact in crypto is. And even though I think it's is unequivocally positive from a regulatory point of view and taking away that side of the problem, he really kind of emphasized a lot of the very negative aspects of crypto with the meme coins, with Liberty Finance, with the CZ pardon, and people who I speak to. And I might 70% of my job is traditional financial markets. I do like 30% crypto. And I remember when the meme coins happened, I was with a client, event in Switzerland, and the reaction was like, "Yep, well, it's crypto." So I think that I'm afraid of scandals that will hurt the reputation of crypto further, and kind of remove that retail and investor appetite to participate. And I think the problem is mostly solved, in my opinion, from an institutional point of view. They're going to move at the speed of implementation and regulatory, but the retail, I think, need to come, and not just got to go gambling on meme coins, but they need to try to get involved and understand and see like what's going on the blockchain, and buy some ETFs, or buy some products, and or try to experience what it is, things on chain. And I think that the reputational risk is a key driver there. And I think Trump polarized that very much. And I'm afraid of a scandal happening in 2026, be it around Trump, be it Liberty Finance, or some leak, or some whistleblower, or maybe something related to Polymarket that I think a lot of people have associated to crypto, or maybe it's going to be a gigantic hack. So I'm afraid of that kind of hit, because I feel like the retail participation is really not there. The enthusiasm is now way behind the institutional enthusiasm, and that for me is like the bottleneck at the moment.
And I think you make a good point there, because I feel like the industry itself, in the crypto sense, there's been a spotlight on the industry because of previous hacks or previous things that you mentioned, right? That paint crypto in a bad light. I think, though, to your point, it really starts with the institutions, and there's a trickle down effect. If you could simplify that sell, right? So we talk about an allocation for both institutional and retail portfolios. What is the most logical path to get someone to understand why you should be invested in these asset classes? for this asset class?
Yeah, I mean, the first thing to overcome this kind of image thing is just to realize that the asset is different than this kind of perception of it. Again, it's just this contamination. Like, you may have whatever view about corporate America, so that doesn't mean you don't buy the S&P, right? It's to understand what the asset actually represents and try to reduce a bit the personalities and the news flow around it. But in terms of the path of investment, I think really is to try to get. I think it's, believe it or not, even though Bitcoin is easier to kind of put your finger on, kind of this digital gold meme, so forth. I think it's easier to get excited about a blockchain like Ethereum or Solana, but I think Ethereum is even a little bit easier because there's more going on. And I think once investors actually, or retail, or experience a little bit of how it works, it starts to become like intellectually very interesting. And I think this is where I think the path really becomes productive. If you're just gambling on a meme coin you saw on TikTok and on Pump.fun, that is a different surface of contact from to crypto than if you're just curious about like, oh, hold on a second, how do this, like, what is this wallet thing? Like, oh, I can put money here. So in this sense, I think companies like Coinbase do a huge service because they are genuinely moving investors on chain, and they have a very good app that works very well, that communicates, and like you have a dashboard, you start clicking on stuff, and you're kind of easing into that, to kind of the DeFi world. You can maybe buy a little NFT or a little token, or I think the curiosity for me is the more sustainable path, because once you get into crypto, it's fascinating. Like I think, everybody who actually gets into it like loves it. Right? It's just really a question of this image. What I'm worried about is the image and the perception. That's what holds people back. So I want a cleaner, even if it's slower. I want like a more genuine path to it.
Yeah, I couldn't agree more. I think the moment you have your own wallet and you're able to move
Yeah,
assets around, you see the speed, you see the cost, you see
exactly.
that the control is yours, right? And so I think you make a
Yeah.
good point there. So
Exactly, and
when you're
it's
thinking
once
about
it's fun. It's kind of fun though. Like
y-
this, it's kind of fun, and like even people who put like $100 in and say like move it here, move it there. Like, they kind of get into it. It becomes like a little bit of like a resource management game. So
yeah,
there is that's the level of engagement I think that we kind of lost somewhere along the way. And in many ways, I think the meme coin mania, like again, it's productive one side, unproductive on the other. That it
mhm.
kind of put crypto back into that frame, that very, you know, um, yeah, endorphin heavy market. So
So meme coins aside, you talk about the valuation model, right? So if you mention something like Ethereum or Solana outside of Bitcoin, because to your point, you could talk about the digital gold conversation. So for something like Ethereum and Solana, how do you think about valuation? How do you think about justifying the price? Um, yeah, across the board, right? Is it protocol level? Is it actual revenue? What are you thinking about?
yeah, so for Ethereum and Solana are blockchains, right? So L1s basically. So that's different from the protocol level. But so I think from the L1 point of view, I think that you have some mix between revenue and I think in crypto they call it monetary premium, monetary value, just like the moneyness of it. Like, do people want to hold it because they believe it will store value or will represent something in the future of the protocol? So those are two levels. The revenue side, I don't think there's any blockchain out there that I know of that can, on the revenue only, be sustainable. Sure, in the NFT mania, Ethereum had huge revenues. Sure, in the meme coin mania, Solana had huge revenues. But on a sustainable basis, I think the revenue side should be thought more of as a floor and as like a nice, a very nice wind, a tailwind for the industry, but not what will move it forward. What will move it forward is the view that you want to own a part of that ecosystem, and you see the potential of it, and you think that that will eventually translate into returns, more interest, be it adoption, like more people want to own the asset for that reason, or because in a limit, once that really can take, if crypto really takes off, then the revenue starts kicking in a little bit more. So the valuation from the L1 level, I think, is still murky, and it's some combination between the two. And of course, then you have the layer of speculative side and the other side. And the last part of that especially L1, is like the market structure, right? So Ethereum, for example, has a very big advantage that it has, BMNR, Bitmine, Tom Lee's Bitmine, that is effectively a long-term holder, and most likely will not be divested. So it has a very positive market structure, like hoovering up ETH. This is a black hole, like MicroStrategy is for Bitcoin. So I think there's that kind of structure that is very helpful as well that may be considered. But ultimately, valuation falls into premium or a revenue. Now, on the protocol level, I think is much more skewed for the long-term investor towards the revenue side. The problem is that the share of investors who are thinking long-term is still relatively small compared to those who are thinking short-term. So the noise to signal ratio is very, very high. So you don't see that yet. But I think we're circling into it gradually until we get to the point in which revenues will become a very important driver. So there's the revenue side and there's the moat. So again, Aave, for example, for me is the greatest indication of moat, because like liquidity is effectively network effects in crypto, right? So Solana, for example, has a very significant liquidity moat because there's a lot of very native Solana people who stay in that blockchain, Ethereum obviously as well. But Aave has that moat of reputation, of liquidity. So I think those factors are very, very important on the valuation side, again, for longer term investors. That's why I think that the tail is going to start dwindling and you're going to see consolidation into those higher, more moat, more network effect assets. The last thing I'll say about this, sorry, rambling here.
This is great.
The last thing I'll say about this is that I think the greatest challenge in terms of I'll say valuation, but I'll say value that crypto faces right now is competition for assets. So the base of investable assets in crypto has grown like exponentially, but like absurdly. On chain, you saw like billions of meme coins, millions of protocols going TG. Every chain has its own Uniswap, has its own Aave, has its own hundreds of protocols, hundreds of governance tokens coming out all the time. And more importantly, I think really is that you have off-chain investments like Coinbase stock, Circle stock. You have all the Bitmine's ETFs, for example, which are an outside investor that restrict the universe of investable assets. So again, the tail, the competition for the tail is impossible. And you have other things like Polymarket bets. So there's a lot more demand for your attention and for your funds than before. So an investor in crypto can now buy stocks, can put your money in Polymarket, can buy crypto or buy an ETF. So there's all kinds of new things to do. And I think that there's not enough money for so many options, basically. That's the idea.
I fully agree. And when I talk to institutional investors, I tell them that there is Bitcoin, more than half of the total crypto market cap. And then there's everything else. And most of you do not have the research person, like you don't have me inside your house to tell you what everything else is and how to value that everything else. So if you want to have exposure to the growth that will come from crypto market, from the stuff being developed on these new blockchains, then the best way forward is to invest into a crypto basket that's created by professionals who decide which tokens are investable.
And we'll re-rate it. It will change the weightings. I think that's also important, right? So, or the rates will change some formula, but that's not static, because if you don't have the expertise, I agree 100%.
Yeah. So in my eyes, crypto is moving to the place where equities and fixed income is at, that most investors, they don't try to make an active decision to identify individual securities that will be successful over time. They go with basket exposure.
I agree completely. I'm
so glad, Gigi.
So to that point, I think just to end then, we talked about the 4-year cycle being over. My last question to you is, are we in a super cycle?
So I think we're in a super cycle of adoption. If we are in a super cycle of asset prices, that I'm not so sure.
Fair enough. All right. Thank you so much. I just wanted to, we both appreciate you coming on and sharing your insights. This is a great conversation.
I love the podcast. Thanks for inviting me.
To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and Marex and are subject to change. Anything we present in this podcast is not intended to be relied upon as forecast, research, nor as an investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results.